So by the time we got to May, I remember vividly analyzing the market and talking about it on Stock Charts TV at that particular point. I was super skeptical because we had this huge rally. But remember, at this point, we're still like wiping off our produce and, really unsure as to what, how civilization was going to recover from this thing. So it's still very much a big question mark. The macro picture was very confusing and very cloudy. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koyfin. Koyfin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koyfin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koyfin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. What happened, though, is there's so much liquidity driven into the system. I think that's what you have to remember. This is something that is underlying the seasonal data and the market data really in recent history, is that there's been a ton of liquidity injected in the system. And what that means is you have quantitative easing, you have the Fed, keeping interest rates artificially low. You've got the U.S. government and others printing tons of money to, basically provide liquidity. They are the buyers of last resort coming in and propping the markets higher. And so maybe without all of that liquidity, all of that artificial buying, maybe the seasonal patterns look a lot more normal. But what has happened is the summer has actually been remarkably strong. And you just look at the middle. These are the calendar years with the thicker lines. Just look right at the middle of the year. That's the May, June, July period. So 2020, coming out of the COVID low, May was a sort of a higher low, and then June, July were stronger. May, June, July in 2021 was pretty strong. 2022 was really the outlier year, even though if you look, like May was technically higher, slightly so. June was actually down. July was a positive month because we were bouncing off of the June low. Then we get to 2023, 2024, and that May, June, July window has been quite strong. Now, in each of those last couple years, we've made pretty good runs going into the summer, which is why a lot of people have been expecting that rollover that never really happened. Now, in most of the last 5 years, we have seen a pullback at some point during the year, but it's usually happened in the fall, right? So in 2020, after the rally, and again, off the March COVID low, most significant low after that was here in September. We had another secondary low around Halloween before rallying into year end. Here in 2021, a pretty bullish year. The most significant pullback, the biggest drawdown of the year was here from the beginning of September into early October. Here in 2022, obviously the outlier year, most of the year ended up being lower, but the big time low was in October. In 2023, we had a sell-off that really did not start in May, and this is what I want to remind you: sell in May was not the story. Sell in July was the story, and really selling at the beginning of August allowed you to be out of the way going into an October low. This year, in 2024, the most recent year, the major low was in August, so a little earlier than average. But again, selling in May, not a great approach. You wanted to wait a little bit. So what's happened here in these last couple of years is we have had a pullback. The market has peaked in the summer. So here we peaked in August. Here we peaked in July. Here we peaked in July. So we have had a peak. It's just been a little later than average. It's been in July or August instead of May. We have had a sell-off into the fall. So that it has happened. That pattern has happened. It's been compressed a little bit toward the end. So how do we patiently wait for that reversal? this gets to what I hope is the main takeaway of this presentation, which is we have to pay attention to the evidence. What market history recently has told us is we've usually had a peak in the summer, just a little later than the spring. It's more of the summer. Then we have had a major low in the fall, which has often presented or provided us a fantastic buying opportunity. And I think the way that you navigate that is look for signs that that summer peak is actually occurring. Now, this is something that Jeff Hirsch in the Stock Traders Almanac actually makes clear. Right now, if you have the Almanac, and if not, again, I'll share a link for you. But if you have the Almanac, he talks about the best 6 months, the best 8 month strategy, and basically what that is it's applying a trend following overlay to the seasonal patterns. Once May hits and it's sell in May time, we don't just blindly sell in May. We look for sell signals. He uses the MACD indicator. I think there are a number of things you can do to confirm that. But you look for signs of that rotation. Given the fact that there's usually a top in the summer, we look for signs that that top is actually playing out. So let's talk about some of the indicators we can use today, sort of identify when that sort of traditional selling point is happening. Again, it may be in May this year, but more likely it's going to be a little bit later. So what can we look for? This is where I would say, so a couple things. Number one, I would say we can look at recent history. And this is one of the charts or one of the concepts that one of my premium members recently shared with me. And I thought it was awesome. And I'm going to share it with you. Here's the weekly chart, the daily chart of the S&P. We're going back for the last 5 years. So sorry, it's a little noisy, but I have it available, so I'm going to do it. Let's look at 2022, right? Really the only significantly bearish year since the COVID low, right? Since that March 2020 low, 2022, definitely the outlier. The other years have been pretty decent. The sell-off that we saw at the beginning of 2025 definitely reminded me, it was an echo of early 2022. So in 2022, we actually peaked right at the beginning of the year. We sold off to about this point, and that's, I can show you in a second what sort of a drop that is, but I don't know the percentages off the top of my hand. And then we had a V bottom, and we made a peak here. Then we sort of had the big move lower, right? That was sort of how 2022 played out. All right, so here's what we're going to do is start to copy these lines. And there's line number 1. Here's line number 2. And I'm basically just replicating this exact thing. So here's what concerns me about the market right now. Granted, we sold off a lot more in going into the April low than we did in 2022, and I'll save this for a second just so we can do this. All right. So I'm going to save this so we can give ourselves a little more room. We can look at the trends a little bit better. I'll give us some extra space here at the end. There we go. And I'm going to show you here. So here in 2022, it was about a 14.5% drop. And you can see that over here on the left side when I use the inspect tool here. So over on the left side of the chart, you can see it's about 14.7% drop, intraday drop from the January 22 peak to that first major low, which was really in late February. Here, obviously, we had a more significant drop. We go down about 21.5%. Intraday basis from the February peak to where we bottomed out there in April. But if you look at what happened, we had a more significant drop, but we also had a more significant recovery. And by the recovery, literally, this is the line I copied from here. You can see if you copy that, 2022 beginning, it's almost exactly where we're at right now. And the problem is, in terms of the timing and in terms of the shape, this is right where we start to roll over. So what concerns me about 2025 is from a seasonal perspective, we're getting to that point where we usually have some sort of sell-off. And also we tend to be matching the beginning of 2022, which I don't have to tell you did not go particularly well for the 6 months after that point, right? April through October was incredibly weak and really fulfilled kind of that classic seasonal weakness going into the fall. And so that's what we could be certainly setting up for. So the seasonal tendencies are weak here going into the summer. It's usually where we usually get a peak. The trend compared to 2022 would say it's very similar. Now, Are these the same world? 100% not, right? Very different administration. Tariffs were not something anyone was really talking about here. That's all people are talking about here. The Fed was in a different place. So many geopolitical situation was different. I mean, so many things were different. The Federal Reserve was in a different part of their cycle. I get it. So from a macro perspective, very different. From a technical perspective, though, I would say the cycle of booms and busts are pretty universal. We can look back at previous bull phases and bear phases, euphoric phases and desperation phases, and see a lot of similarities, even though the macro environment can be very, very different. So again, what concerns me is if you look at sort of the most recent real bearish year, this is actually a very similar setup to what we saw in March of 2022 before things started to get a lot worse. So again, as I was saying earlier, I think what you need to do is start to think, all right, well, what happened here that can help us sort of compare that or relate that to what we're seeing today. So here's what I would say, just kind of cleaning off the annotations there for a second. So what happened at this point? I think what we need to do from here on in the weeks and months to come is think about three things. Think about price action, think about breadth conditions, and think about leadership. Okay, three things have happened, that have changed from 2025 from the February peak to the April low, and 2025 from the April low to where we're at in late May. And I would say price, breadth, and leadership are those three main things. In terms of price, we've had a significant rally and we've recovered above the 200-day moving average, which is usually a really good thing, right? Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. So it's important that we've recovered that, what I call a long-term barometer. If you look what happened back here in 2022, though, is the exact same thing happened, right? We had this sort of very deceptive, very seductive recovery phase where we broke above the 200-day moving average. That felt very optimistic here. And to be honest with you, I remember at this point, we had broken to a new swing high. We'd broken above that February peak. It felt pretty obvious that we're going to go retest the previous all-time highs from the beginning of the year. But then things started to change. And what you have to remember is this was the most damning piece of evidence we can see on the daily S&P chart, was that we did not hold the 200-day moving average. I would say, given the rally that we've had, and we're getting a bit of a sell-off here as we're doing the webcast, and my internet's cutting out. It looks like the market's shorting out a bit here. So we'll see what happens through the course of the trading day today, of course. But, I've been telling my premium members, in the last week, we've seen some short-term signs of exhaustion. We've seen some distribution days. We've seen leading stocks start to stall out. It seems like a tactical pullback to the 200-day makes a lot of sense here. And maybe we're starting to see the beginning of that here, this week. But I would say what happened in 2022, which was a real issue, was we failed to hold the 200-day on that pullback. I think 2022, if we hold that 200-day, all of a sudden looks like a very different year. All of a sudden looks very encouraging going into the summer months. Here, we're kind of in the spring months and getting near to the summer where there's usually a major peak. I think holding the 200-day is pretty important. I think if we don't, I think that's where you can find a lot more sellers start to come in. A lot less buyers are willing to take a shot when now we have to deal with the market potentially retesting the April low. So I would say from a price perspective, holding that 200-day is going to be vital. And that's something I would absolutely be watching to see if that holds or not. We've been talking on a market recap show, this shaded area, this price gap. I think that's all part of that same sort of support level, that line in the sand. I think if that holds, then all of a sudden 2025 probably is not going to play out like 2022, and we maybe get a recovery and we have a high later in the summer to deal with. But price deterioration would be one thing that would tell me that seasonal peak we usually have in this in this period is probably happening now. So look for weakness, look for a failure to hold the 200-day moving average. So that's a piece of evidence number one. Second thing I would be looking for would be breadth deterioration, and we may be starting to see that. That's another sort of issue that I'm watching here. This is one of the ways that I like to follow breadth conditions, is look at the S&P and then look at the percent of stocks above their 50-day moving average, which is at the bottom in green, percent of stocks above their 200-day moving average, which is here in blue. As of this moment, when I'm bringing it up on stock charts, 72% of the S&P members are above their 50-day moving average. That's pretty good. right around 51% of S&P members are above their 200-day. What's happened in the April low to late May, where we're at right now, is that breadth conditions have become incredibly strong, right? So in early April, we're down to 20% of stocks above their 200-day moving average in the S&P 500. We got up to almost 60% at the end of last week. So we've had a resurgence in breadth where most things were below their 200-day and most things have now recovered their 200-day. So I think it's crucial that that holds, right? That we hold over half of stocks holding their 200-day moving average. If not, then again, maybe we're in that seasonally weaker pattern then. In terms of stocks above their 50-day, here at the April low, less than 10% of the S&P members were above their 50-day. It got up to 80% at the end of last week. So almost the entire S&P was below its 50-day moving average a month ago. And then in the last 4 or 5 weeks has regained the 50-day moving average. So we've had a resurgence, and it's not just a couple things that are bouncing. Everything's kind of bouncing higher is what that breadth indicator is telling you. The problem is when an indicator like this gets really overheated, that's when it can start to come out of that overextended region. That's when it breaks back below 75, 70%. And that's where it could tell you, all right, all those things that were rallying off of the lows are now starting to not hold their 50-day moving average, starting to come down a little bit. So I think watching breadth indicators like this to see if there's a failure, what we call a breadth deterioration signal, I think would be maybe a confirmation that we're starting to rotate lower. So the breadth can take a lot of different forms. This is one of the things I'll be watching. The bullish percent indexes are breadth indicators based on point and figure charts, just the cumulative advanced decline lines, which overall have been quite strong. Maybe we see a rotation lower there. This is what that looks like, by the way. So these are the cumulative advanced decline lines for the New York Stock Exchange for large caps, mid caps, and small caps. The S&P advanced decline line is the only one that's made a new all-time high here in 2025. The rest of these are still below the peak that we established. Most of these peaked out in around Thanksgiving of last year. So I would say for now, the breadth is okay. I mean, it's pretty good. I would say if the advanced decline lines really start to rotate lower, which would tell you over a series of days, we're seeing more stocks closing down than closing up. That's what would tell me breadth is starting to deteriorate. Volume probably is part of that as well. Looking at Chaikin money flow, looking at the McClellan oscillator and seeing if that rotates below zero. Those would all be things that would tell me conditions are getting pretty rough. This is updated at the end of every trading day. Given what I've seen so far today, and again, there's a lot of game left, but barring some huge rally into the close, it looks likely that the McClellan oscillator turns negative today for the first time since mid-April. So for the last month, the McClellan oscillator has been above zero, which means it's basically looking at the trend in the advanced decline data. It's been pretty positive since about a week after that April low. If we turn back negative, that tells me that stocks are, the advanced decline data is starting to change. The trend is starting to evolve. So number one, price breaks down key levels of support. I think the 200-day is vital. Number two, breadth deteriorates. And we may be starting to see that if the McClellan oscillator breaks below zero, if less than 50% of S&P members are above their 200-day. Those are the kind of things that would tell me, all right, even if the S&P and the NASDAQ are holding up okay, a lot of stocks are already starting to break down.